Brookfield Infrastructure is a utility business with assets all over the world. It owns and operates railroads, terminals, pipelines, transmission lines, toll roads, data centers, and data distribution in Europe, India, North America, South America, New Zealand, and Japan. It's a globally diversified utility business that has also consistently outperformed the S&P 500. Well, until recently. Brookfield Infrastructure stock is down 52% from its all-time highs after a short report came out saying the company's dividends are unsustainable, the business has been inflating its asset values, and the company is overpriced relative to its book value versus other companies in the sector. In today's video, I want to discuss why I think this short report is irrelevant, and also why I believe Brookfield Infrastructure at its current share price is a significant opportunity for investors. Full disclosure, I have been buying BIP shares in my portfolio, and I do own the stock. I also plan on continuing to buy more shares if they remain low as well. Additionally, I will be reviewing Brookfield Infrastructure's Q3 financial report tomorrow in my Discord community. If you're interested in hearing my thoughts and analysis on the third quarter report, then you can do so by joining my Discord community through my Patreon, which I will leave a link at the top of the description. In my Discord community, I also discuss stocks that never make it onto my YouTube channel. So if you want to see everything I am buying and when I buy it, then again, you can do so through my Patreon. But with that being said, let's dive into Brookfield Infrastructure and start with the two main bearish points that the short report tries to make, which are: Number 1, Brookfield's FFO includes asset sales, which means Brookfield Infrastructure needs to continue selling its assets to continue paying its dividend. Or in other words, the business's cash flows do not cover the dividend. And number 2, Brookfield Infrastructure's net asset value, or book value, is low relative to its price and other utility stocks, suggesting the business is currently overvalued. So let's tackle these 2 points one at a time, starting with number 1. So I went through Brookfield Infrastructure's second quarter earnings release, its SEC filings, its investor presentation, and all of the documents that I could find, and I found this right here, which explains what Brookfield Infrastructure adds and removes to its FFO calculation. And this underlined segment right here specifically says, FFO does not include the impact of market-to-market gains or losses, which is basically saying that Brookfield Infrastructure's FFO does not include its asset value gains or its unrealized gains or losses on the positions that it holds. Now, additionally, this next screenshot right here shows exactly what BIP adds and subtracts from its FFO calculation. So right away, we can see that FFO removes its share of earnings from its investments. However, it does include the FFO it receives from those investments, which is basically Brookfield Infrastructure's share of its investments' cash flows. Then it removes mark-to-market gains, which we have already discussed. Also removes gains on dispositions of subsidiaries, associates, and joint ventures. So this right here is actually the amount of money that Brookfield Infrastructure makes from selling off its other businesses or assets that it owns. And right here, we can clearly see that this number is subtracted from FFO, whereas the short report is saying that this number is added back into FFO to ultimately boost Brookfield Infrastructure's FFO and cover the dividend. However, again, when you look at this calculation right here, it's very clear that the gains on dispositions of subsidiaries or their asset sales are removed from FFO. This is to better show the investors how much actual cash flow Brookfield Infrastructure's operations are generating. So in my opinion, the FFO figure does accurately show how much cash flow Brookfield Infrastructure's operations generate. I also found this in BIP's second quarter earnings results. On June 15th, 2023, a subsidiary of Brookfield Infrastructure sold a portion of its interest in a U.S. gas pipeline for net proceeds of approximately $420 million, decreasing its ownership from approximately 38% to 25%. On disposition, Brookfield Infrastructure recognized a gain of sale of approximately $80 million. Then again on June 15th, 2023, Brookfield Infrastructure sold an effective 12% interest in its New Zealand data distribution business for proceeds of approximately $275 million. On disposition, Brookfield Infrastructure recognized a gain of sale of approximately $220 million. Now, additionally, on June 15th, 2023, Brookfield Infrastructure, along with institutional partners, completed the sale of its interest in its Indian toll roads operation. The sale resulted in net proceeds of approximately $180 million. Our partnership recognized a gain on the sale of approximately $100 million. So all of these sales right here add up to around $400 to $500 million in gains that Brookfield Infrastructure realized on asset sales in the second quarter of 2023. Now, again, on its FFO calculation, these gains on dispositions of subsidiaries, associates, and joint ventures are removed from FFO very clearly right here. So once again, I do believe the short report is false and irrelevant because Brookfield Infrastructure removes these asset gains in all forms from its FFO calculation to show how much cash the business is actually generating. Additionally, I went through Brookfield Infrastructure's investor presentation from the second quarter, and this is a very detailed breakdown of exactly where Brookfield Infrastructure gets its money from and where it raises money from, and then also spends its money. So it basically just shows where money is coming in, how it comes in, and then where the money is also going. So right at the top, we can see that Brookfield for the 3 months ended June 30th in 2023 generated funds from operations of $552 million. It then had maintenance capital expenditures of $130 million, which means the company was left with funds available for distribution of $422 million. The company then paid out dividends of $377 million. And then we can see it had funds available for reinvestment of $45 million. So after Brookfield Infrastructure paid its maintenance capital on all of its assets and then also paid out its dividend, it still had $45 million left over to invest in growth or do whatever it wants with. We can then see the business has growth capital expenditures of $374 million, and it took on $269 million of debt to help fund these growth capital expenditures. Then there were also non-recourse debt repayments, and then this one right here is a big one. Proceeds from capital recycling in the second quarter of 2023 was $991 million. So this right here is the asset sales that Brookfield Infrastructure is getting on its capital recycling program, or the money it is getting from selling off assets essentially. These proceeds, once again, are not included in the FFO figure that it reports up above. These are separate proceeds that the business gets from its capital recycling program. Then we can see Brookfield Infrastructure had new investments of $774 million. So its capital recycling program is a large source of cash flow for the business, and this is largely where the money comes from and how the business continues investing in growth. So basically how I view this is the operations of Brookfield Infrastructure help maintain the business, help grow the business slightly, and are used to pay the dividend. And then Brookfield Infrastructure's capital recycling program, which is buying assets at discounts, fixing them up, improving their cash flows, and then selling them at higher multiples and prices, is how the business actually continues funding its growth, or in large part continues funding its growth. And in reality, at least in the second quarter of 2023, this is actually where the most cash flow for Brookfield Infrastructure came from. It was almost double the amount of money that it produced on its operations. So this is a significant business and it is a significant source of cash flow for Brookfield Infrastructure. In Brookfield Infrastructure's investor presentation, they also show some of their most recent asset sales. Here we can see they achieved an 18% annual return on their US natural gas pipeline, a 31% annual return on their New Zealand data business, and 15 to 21 multiples of EBITDA on their gas storage, which is significantly higher than the multiple they paid. Brookfield in general has a long history of effectively investing and recycling capital to produce profits for its shareholders. However, Brookfield Infrastructure does not use these gains on its asset sales to fund its dividend. It uses them to continue investing in new assets and growth for the business. Also, what is very important to point out is that the short report did not say anything about Brookfield Infrastructure's capital recycling business, which is where the largest portion of the company's cash flow even comes from, at least so far in 2023. Therefore, the first point on the short report that Brookfield Infrastructure's dividends are covered by asset sales and not by operating cash flow is false, at least in my own opinion and based on all of the data that I have shared in this video so far. So now let's move on to point number 2, which is that Brookfield Infrastructure trades at a high net asset value relative to the sector. And this point is accurate. If we go and take a look at Brookfield Infrastructure's price to book versus Fortis and Duke Energy, which are massive infrastructure businesses in the United States and in Canada, we can see that Brookfield Infrastructure's price to book currently is sitting at about 1.9 versus Duke Energy's 1.4 and Fortis's 1.245. We can also see that historically Brookfield Infrastructure's price to book has been 3.8, which is basically double the other two infrastructure or utility businesses. However, when we add in NextEra Energy, which is another major utility provider, to this chart, we can see that its price to book ratio is about 2.49, which is even higher than Brookfield Infrastructure's. So there are other utility businesses out there with higher price to books than Brookfield Infrastructure. But even still, I don't really understand this whole argument of using net asset value or book value to value these businesses at all. Brookfield Infrastructure's investor relations even had their own things to say about this short report, and I'll read this out very quickly. BIP doesn't report net asset value, but the assertion that we are carrying assets on our book that are grossly overvalued is false. Our asset valuations go through extensive internal due diligence and are heavily scrutinized by third-party valuators, auditors, and our private fund limited partners, which BIP invests alongside. So BIP themselves say their assets go through extensive internal and third-party due diligence. And then heading back over to Brookfield Infrastructure's response, they say, "We believe funds from operations, FFO, is the best representation of the operating cash flow our businesses generate. It is with this cash flow that we pay our distributions, as well as reinvest in our business and repay debt. We have grown FFO on a per-share basis by 11% over the past decade, and grown our distribution by 9% over the same period. Our target is to increase the distribution by 5 to 9% annually, and we believe this is sustainable. What's missed in all of this is the successful execution of our strategy of buying, enhancing, and selling assets. Since its inception, Brookfield Infrastructure has sold 28 businesses for over $8 billion, with an average internal rate of return of nearly 25%. 85% of these businesses were above the high end of our targeted 12 to 15% internal rate of return range. This clearly demonstrates our strong cash flow generation and realized gains above our targets over our entire history. So Brookfield Infrastructure themselves is saying they believe FFO is the best metric to use, and that FFO does in fact cover its dividend. Additionally, they say they have sold 28 businesses for $8 billion in proceeds with an average return rate of nearly 25%. Which again, the short report does not mention at all, even though this is a major part of the entire business model. So this all basically debunks the short report as well. Now, additionally, I do not value businesses based off of their book value or net asset value. To me, valuing a business is all about cash flow potential and how much cash the business can return to me in the future. In fact, Warren Buffett has stated that the number one question an investor should answer is how much cash can a business return to you versus the price that you are paying for it. And book value does not help you answer this question at all. Warren Buffett also has a great clip from one of Berkshire's annual meetings where he explains why he no longer uses book value when analyzing and valuing stocks. So let's watch this quick clip and then I'll explain it a little bit more afterwards.
And earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider, and as we mentioned earlier this morning, earnings have been poor for a great many Japanese companies. Now, if you think that the return on equity of Japanese business is going to increase dramatically, then you're going to make a lot of money. I mean, and you're correct, you're going to make a lot of money in Japanese stocks, but the return on equity for Japanese businesses has been quite low, and that makes a low price to book ratio very, very appropriate because earnings are measured against book. And if a company's earning 5% on book value, I don't want to buy it at book value if I think it's going to keep earning 5% on book value. So a low price book ratio means nothing to us. It does not intrigue us. In fact, if anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book, because the chances are we're looking at a poor business in the first case and a good business in the second.
In this clip, Buffett says it is not the book value that tells you the value of the business, but rather its future earnings potential. Businesses should be valued based on the amount of cash they can produce and return to their shareholders, not by how much asset value they have on their books. Additionally, Buffett goes even further to say that typically higher quality businesses sell for higher book values because they earn and produce more money on their assets. Visa is a great example of this. The stock currently trades at 12 times book value because the business is insanely profitable. This doesn't mean that Visa is overvalued. It just means that the business is able to generate a significant amount of profits on the assets that it does have. In fact, Visa has a perfect 5 out of 5 on stock unlocks profitability, with a nearly 60% free cash flow margin. In conclusion, what matters when valuing a business is future profit potential of the business, and not its net asset value or book value. So what we can do is head back over to Stock Unlock and compare Brookfield Infrastructure versus Fortis, Duke Energy, and NextEra Energy. And we're going to take a look at all of these businesses' price to operating cash flow, price to EBITDA, and price to operating income. Now, the freeform tool is pretty messy because we have a lot of metrics in here, and you can see that there's just a lot going on. So let's scroll down to this table down here of all of the different metrics. In the price to EBITDA section, we can see that Brookfield is trading for the lowest price to EBITDA of only 2.44, which is also significantly below its historical average of 6.8. In the price to operating income section, we can see that Brookfield Infrastructure is once again the cheapest by far, sitting at a price to operating income of only 4, which is also well below its historical average of about 12. And finally, if we take a look at the price to operating cash flow section, once again, we can see that Brookfield Infrastructure is the cheapest by far, sitting at a price to operating cash flow of only 4.6, which is well below its historical average of 9.88. So in terms of all of these different profitability metrics, Brookfield Infrastructure is actually selling for the cheapest prices out of all of these different businesses. Now, additionally, what we can do is add in operating income, operating cash flow, and then even EBITDA to this chart, and go and take a look down here at this table once again. In our EBITDA section, we can see that Brookfield Infrastructure has managed to compound its EBITDA at a 22% compounded annual growth rate over the past decade, which is significantly more growth than the other three businesses. Now, in terms of operating cash flow, Brookfield Infrastructure has also compounded the fastest at 17.2%, which is a little bit faster than Fortis and significantly faster than NextEra Energy and Duke Energy. Now, finally, in terms of operating income, Brookfield Infrastructure has managed to compound its operating income at 21.5%, which is significantly faster than the other businesses as well. So what I am seeing is that Brookfield Infrastructure has historically grown the fastest, and it is now trading at the cheapest valuation out of its peers by far, when looking at its current price multiples. Brookfield Infrastructure is selling for a higher price to book than Duke Energy and Fortis, but this just means that it is able to generate more profits on its equity. Using price to book to say the business is overvalued is not how I or Warren Buffett view or value investments. So this entire argument of Brookfield Infrastructure being overvalued based on its net asset value, in my opinion, isn't valid at all. So now let's move on to why I think Brookfield Infrastructure is selling for an attractive price today, and why I decided to buy some shares on all of the short report fear and the stock market selling off. So what we are going to do is remove every other stock from our freeform tool, and we are going to go back and take a look at Brookfield Infrastructure's price to operating cash flow, price to operating income, and price to EBITDA. And let's zoom out all the way to 2011. So right here, we can see that BIP's historical average price to EBITDA is 7. Currently, it is at 2.44. Its historical average price to operating income is sitting at 11.7, and currently it is 4. And finally, its historical average price to operating cash flow is 10, and currently it is sitting at 4.6. All of these ratios are 50 to 70% below its historical averages. So relative to how the market has historically valued Brookfield Infrastructure, right now its shares look like it is ridiculously cheap. Now, if we also take a look at Brookfield Infrastructure's historical dividend yield versus today it is sitting at about 7.1%. And historically, the highest the dividend yield has ever gotten over the past 12 years was 7.9% in January of 2016, right here. Also, Brookfield Infrastructure's historical average dividend yield is about 5%, so its current dividend yield is significantly higher than its historical averages as well, and it is selling right near its historical highs. Additionally, from that low in 2016, when Brookfield Infrastructure's dividend was in the 7% range, it has produced total returns slightly higher than the S&P 500, even though the stock is currently in a massive 52% correction. This suggests that historically, when Brookfield Infrastructure's dividend gets this high, it seems to see strong growth to its share price afterwards and produce significant amount of returns to its shareholders. Now, if we go back over to Brookfield Infrastructure's investor presentation, they explain their dividend and their dividend objectives. The first underlying point here says that Brookfield believes a payout ratio of 60 to 70% of FFO is appropriate. They're also targeting 5 to 9% annual distribution growth in light of expected per unit FFO growth. And then lastly, they say that their distributions have compounded at an annual growth rate of 8% over the past decade. This means that Brookfield Infrastructure is currently offering a 7% dividend that has historically grown at 8% annually, which in my opinion seems quite attractive. Additionally, we can see that from 2012 to 2022, Brookfield Infrastructure has grown its FFO per share at 11% annually. And over the next 1 to 3 years, the company is projecting to grow its FFO per share at 12% annually as well. Based on their projections for 2023, this means Brookfield Infrastructure is projecting to do at least $4.14 per share in FFO by 2026. If they pay out 60% of their FFO per share as a dividend, which is the lower end of the company's goal, then that would be a $2.48 per share dividend. On today's share price of $22 per share, that is a dividend yield on cost of 11.7% within just the next 3 years. In my opinion, that is a very attractive dividend yield on cost in a very short amount of time. Additionally, BIP is projecting annualized FFO of $3.05 by the end of 2023. This is a price to FFO of 7.2 on the shares today, which I think is very attractive for a business that is projecting to grow its FFO per share by 12% annually over the coming years. So what I think is going on here is BIP is selling off due to a lot of fear from this short report and the overall utility sector being hit quite hard this year. However, when you take a look at their short report versus BIP's own documents, the short report does not make much sense and is kind of irrelevant, at least in my own opinion. Brookfield Infrastructure also has a track record of growing its business incredibly well and doing a great job buying undervalued assets and selling them for significant gains. And I believe that the company will continue to do this in the future. It's also a business that has consistently outperformed the S&P 500 and grown its dividend at high growth rates. It's projecting to continue growing its profits at double-digit growth rates in the future as well, and is now selling for its lowest price ratios in over a decade, while also offering a over 7% dividend yield. So to me, I think it looks incredibly cheap, and I have started my position and will continue to add to it if the stock does remain down. Brookfield Infrastructure also reports tomorrow morning before the market opens. I am not expecting them to say anything about the short report, and I am expecting them to post a strong quarter and reaffirm the business's future guidance. I am not sure how the market is going to react to the earnings tomorrow, but right now it's pricing BIP as if it has serious problems, which I personally do not believe it does. I will also be going over Brookfield Infrastructure's Q3 report in my Discord community. So again, if you would like to get my real-time thoughts and analysis before I end up making a video, then come and join my Discord community by becoming a Patreon member. By doing so, you will also be supporting my channel and helping me continue making videos like this for everyone. But that is going to wrap up the video, everyone. So thank you so much for watching, and I truly do hope that you enjoyed and appreciated this video. If you did, then please remember to leave a like on the video, and if you want to stick around and see more of my content, then please consider subscribing to my channel as well, because that would be pretty awesome. But with all that being said, thank you all so much for watching. I truly do appreciate it, and I really hope to see you all again in my next one.